Hello everyone, I am Ankit and you're watching the StudyIQ IAS English channel. In our today's video, we'll be understanding a very important topic in economy, that is initial public offering, which is also relevant from stock markets in general. Now, such kind of questions from stock markets, from financial markets, they are being increasingly asked in UPSC exam. So that is why such kind of a concepts like initial public offering, which occurs frequently in the news, becomes important. So I'll tell you everything that is relevant from exam, particularly relating to initial public offering, which is a offering done by companies in the equity markets in India, right? Now, first, let us understand the context. Why are we discussing about IPO today, right? Now, you understand a very famous company known as OpenAI, which is responsible for products like ChatGPT. It said that it is willing to a potential IPO in future depending upon many conditions like company's own readiness as well as how public markets respond in general, right? So in this regard, what is an initial public offering and why does company actually issue initial public offering? That becomes important. Let me give you a very simple example, right? Now suppose I am Ankit and I own a company known as XYZ, right? And the owner of this company, the sole owner is me, Ankit, right? And suppose hypothetically this company has gotten very big in terms of business and the current value of this company stands at rupees 100 crore. Okay. Now suppose I need 20 crore rupees. Why do I need 20 crore rupees? Because I'm ambitious and I want to increase the size and scale of this business and I want to grow my company, right? So obviously, in order to grow the company, I'd want to create new factories. I want to send products to larger markets, right? So for that, I might need some capital to undertake construction of new factory, expansion of existing factories. So for example, hypothetically, I need rupees 20 crores for these requirements. Now I have three options. That first, I use the profits of the company that the companies have made previously to use these profits and undertake the capital expansion. But you understand, being a 100 rupee value worth of company, having a 20 crore profit at once is a quite difficult task. And even if I have 20 crore rupees as profit, I might need some of the money for future expenses, right? So I might not use these profits. So the other option that I have is go to a financial institution like a bank and demand them to give me a loan. But the bad part about loan is that you have to return the money. You have to pay the principal amount. And in addition to that, you also have to pay interest on it, which, for example, if I take a 20 crore loan, that interest would also amount to several crores, right? So that is why second option is also not a very attractive option. So the third option that I have is I go to public in general, public like you and I demand them, please invest in my company. And when you invest in my company, I will give you part ownership. So suppose my value of my company was 100 crore rupees and I'm demanding from public to give me 20 crore rupees. So I'm saying that please provide me 20 crore rupees and in return, I will provide you 20% ownership in my company, right? So this is how companies divest their investment, they divest their ownership and they divest this ownership to different owners in terms of taking capital from them. And this process is called as an IPO. That I was the only owner of the company previously, but now I'm parting 20% of my ownership to other people in return for them investing in my company, right? Now I told you I need 20 crore rupees from people and I said that the value of one share of my company will be 10 rupees. So from that value, when I'm demanding 20 crore of investment from other public and I'm saying that value of my shares is rupees 10, then I'll have to sell 2 crore shares in the market, right? And automatically, when the remainder part of the ownership will vested with me, that is 80% of ownership after this IPO happens, I will be controlling 8 crore shares. So this is how, by selling 2 crore shares in the market, I will allow people to invest 10 rupees per share at a time and ultimately I will be getting a capital of 20 crore rupees from public investors. So suppose three people decide to invest in my company, person A, person B and person C, and suppose person A decide to buy 1 crore shares, and what is the value of one share? 10 rupees. So therefore person A invested 10 crore rupees in my company, therefore person A becomes 10% owner of my company. Similarly, person B invested or bought 60 lakh shares of my company, and when one share equals to 10 rupees, this means person B invested 6 crore rupees in my company, and therefore now person B becomes 6% owner in my company. Similarly, the rest amount of shares, that is 40 lakh shares, were bought by C, and therefore C made an investment for rupees 4 crore, and now person C becomes 4% owner of my company. So understood? Earlier I had 100% of ownership in company XYZ. I parted 20% of my investment away, and I sold 20% of my shares to three people, and now irrespective of their investment, they are now owners of 10%, 6% and 4%. And this process of company XYZ selling its share for the first time to public A, B and C, this is called as an IPO, and this is the transfer of shares from company X to these investors, and this is an example of what? Primary market. Understood? This is an example of primary market. Now person A had 1 crore shares, person B had 60 lakh shares, and person C had 40 lakh shares. And suppose if they want to sell these shares to other people like D, E, F. So what options D, E, F have? They only have options to buy these shares from these people. And where this transaction will happen? This will happen in a market called as stock market. So now the shares are being transferred from investors to other investors indirectly, and this is called as a secondary market, right? Understood? Let me give you another very simple example. Suppose I'm a potato farmer and I'm selling my potato to consumers like you. So this is an example of primary market transaction that happens from potato grower to potato buyers like you. But I'm a potato grower, I can also go to mandis and sell my potatoes, and you have to go to mandis and buy those potatoes. So that will be an example of secondary market transaction, because you're not buying potatoes directly from me, you're buying potatoes from mandis where I've sold potatoes, right? So this is how the difference of primary market and secondary market works. Understood? Now let us understand, after understanding all these examples, let us understand the theory of IPO. It is referred to a process by which a privately held company, here the word private does not mean it is a private company or a government company. Private limited means that the ownership of that company is limited to only handful of people. It can include government, it can include business people like Mukesh Ambani, like Gautam Adani, right? So here privately owned or privately held does not mean privately owned or government owned, right? So it can be a private company like Reliance, it can be a government owned enterprises like LIC, like Indian Oil, like ONGC, like other NTPCs, etc., right? And the process when they offer share to the public or to new investors for the first time, this is called as IPO. And suppose for the second time they are investing their shares, right? So I told you, I now hold, after IPO, I hold 80% of ownership. And suppose I want to sell further 10% of ownership in my company and reduce my ownership to 70%. So that second time of issuing of share will not be called as IPO. That will be called as further public offering or follow-on public offering, called as FPO. Understand the difference? So the first time owners decide to sell their stocks in the market, that is called as IPO, and eventually after that they decide to sell more stocks, that will be called as FPOs. So the reason why company sells shares in the public for the first time, maybe to raise capital, like the ones I told you. Suppose company wants to take business expansion, company has some other financial obligation, they may decide to raise capital from investors, and this is the primary reason. Other reasons include the company owner want to diversify and broaden their stakeholders, or if one of the existing owners of the company, if they decide to sell their stock and pull their investment from the company, they also can sell their shares in the public. So these are the reasons why many companies opt for IPO, and the IPOs are very famous in the market. So whenever a big company will be offering IPO, you'll see a lot of chatter in the newspapers. And IPO is the first step in the process of listing of a company on a stock exchange like National Stock Exchange, like Bombay Stock Exchange, or stock exchange of foreign countries like Dow or New York Stock Exchange, right? So this is basically the theory of IP. Now let us understand what is the process of listing of IPO, right? So suppose I'm a company owner XYZ and I want to sell shares for the first time in public. So I go to the market regulator, and who is the stock market regulator in India? That is Securities and Exchange Board of India, SEBI. So I go to a SEBI, and SEBI will ask me to fill an offer document, and this offer document is known as draft red herring prospectus. And in this document, the company owner will have to highlight all the relevant information about the company: who are the owners of the company, what are the existing projects the companies have invested or constructed in, what are the financial details like revenue, like profit or loss of the companies, similarly what the company will do from the money that it will take from the market, the purpose of raising the money, what is the terms on which they are offering the shares to public. All of this information the company will have to fulfill and submit it to the stock market regulator SEBI in form of draft red herring prospectus, DRHP, right? Similarly, this listing process also mandates that after listing of this company on stock markets, company will have to continuously provide these financial information in the market so that shareholders know what is going on in the company. So suppose if a company is making very good profit, you understand, more and more people would want to invest in your company, and similarly vice versa is true. And suppose company is making a loss, people would want to sell the shares in public, right? Why would they want to continue investing in a company that is making a loss? So that is why these bring certain disclosures, and this mandates certain disclosure on the company that they have to continue making so that it benefits or takes care of the interest of stakeholders, and therefore companies will have to follow more stringent compliance after they are listed in the stock market. So this was how the process of IPO works. Now let us understand which companies are eligible to actually file for an IPO. Now SEBI obviously has mandated certain criteria to be fulfilled by companies, because not any company can go for IPO, right? So therefore a company has to fulfill certain criteria. What are these criteria? Let us find out. Now a company, to fulfill for an IPO, they have to have at least a net tangible asset of at least 3 crore rupees. Asset mean building, lands, properties, etc. Similarly, they also need to have a net worth of 1 crore in each of the preceding 3 financial years before which they are filing for an IPO. Similarly, a company must have a minimum average pre-tax profit of rupees 15 crore for at least 3 of last 5 years before they are opting for an IPO. And if the company satisfies either of these 2 conditions, only then they are allowed to file for an IPO by the stock market regulator SEBI. Now the biggest question in our today's discussion: who can, or what is the process of fixing the prices of an IPO? Now in the example I told you hypothetically that the value of my company is 100 crore rupees and I've decided to sell one share at a price of 10 rupees. But the value of the company or the price of share is arrived after a long discussion which is held by the issuer of the IPO, that is the company who's bringing the IPO, and they enlist the services of a service provider who fulfills to fill all the regulatory requirement, and this is basically called as a merchant banker. And these 2 entities, after discussing the factors like assets, revenues, profit, future cash flow expectation, total value of the company, they arrive at what is known as total valuation of the company. So this I told you in the example, right? Suppose my company is valued at 10 crore rupees, and after arriving at the value, then they decide how much amount of money I want to raise, and accordingly they decide this is the amount of ownership I am willing to let go to other investors, and accordingly therefore they arrive at the price of shares that will be offered in the market. Understood? So this basically is a calculation of total valuation of the company, which depends on assets that the company has, the kind of buildings, lands, etc., the kind of revenue the company makes, the kind of profit the company makes, and what is the future cash flow, whether this company is going to grow further or not. This is all factored in before they come at the value of the company, and ultimately based on this they decide the value of the shares. And the market regulator SEBI does not have any role in deciding what will be the value of the shares that will be offered to public. Understood? Now, another important aspect that you need to understand, who are eligible to invest in the IPO. Now, technically, anyone over 18 years of age who is having a brokerage account in apps like Zerodha, Grow, or even service providers like ICICI Direct, if you have a broking account or a demat account and you are 18 years of age, you are eligible to opt for an IPO. And accordingly, the different kind of investors are categorized differently by SEBI. The biggest investors or the big bulls in the stock markets, they are called as qualified institutional investors because they invest a large amount of money at a single time, which includes foreign investors like FPIs, mutual fund companies, commercial banks, insurance companies, pension funds. These are big bulls in the market who invest crores and crores of money at once, right? Similarly, other investors like you and me, we are called as retail investors. Why we are called as retail investors? Because we are the ones who invest up to 2 lakh rupees in an issue. But if you invest more than 2 lakh rupees in an issue, you'll be categorized as a high net worth individual, right? So basically, the biggest of the investors are called as qualified institutional buyers. Retail investors are the one who invest for less than 2 crores in an issue, and if you invest more than 2 lakhs in an issue, and if you invest more than 2 lakhs in an issue, you will be called as a high net worth individual, right? So this is the categories of investors, and technically anyone over 18 years of age, they can invest provided you have a demat account, right? Now, before concluding our today's session, let's see how many of you are able to solve this question. And please comment me with your correct answer in the comment section, and if you are answering it correctly, I will give you your answer a thumbs up. And if you want to download the notes, they will be available on the Telegram channel ATS Live. So go and subscribe to it by entering the words ATS Live on the top right hand corner of an app, and this is the QR code which will also take you directly to the channel, right? So this is also everything from my side. We'll see each other again tomorrow. Please have a very good night.